Hello and welcome to the Framework Basics. First of all, we're going to have a look at what is the conceptual framework. Well, first of all, it's just the basic principles behind accountancy, behind financial reporting standards. So every time there's a new standard, we look to the conceptual framework to try and help us out. What does it tell us about definitions of assets, or definitions of liabilities, or who the financial statements are for when we're looking to create new standards. Similarly, if the old standard on stock or non-current assets isn't clear, if it's not the individual point you're looking for is not in the standard, well, that's fine. Go have a look at the conceptual framework and it will tell you the principles of what's actually needed there. Okay, so that's what it is. Well, why do we do it? The key one, consistency. Consistency from year to year in the accounts, and more important, consistency from a company to a company, that they are applying the same principles, and of course consistency of accounting standards, that the accounting standards are built upon the very same principles. Linked to that then, the accounting standards, there's no need to keep on re-evaluating what's the definition of an asset, what's the definition of a liability. Every time we come to do a new standard, when do we recognise something? It's already been looked at once in the principles, so it doesn't need to be looked at again. And then finally, as we've seen in America, the rules can become really cumbersome. If you try and cover all situations, you get this huge tick box of rules to follow. And of course, if the rules aren't there for your particular scenario, then again you've got problems. However, why would we not do it then? Well, first of all, it's said in the framework that investors are the main users of accounts. But that may be true, but what about employees? What about the managers themselves? Different users have different needs, and so therefore the different standards should be shown separately, perhaps. I've just been looking at an email about the exposure draft on leases, and again that's been put further back. It's been re-exposed, as has the standard for revenue recognition. Okay, so even though we say it speeds up the process, does it really? And finally, how can one principle be agreed for all different situations? Surely different principles account for, or should be taken into account for the different scenarios. Is the principle for a management decision the same as a principle for an investor's decision? And so on. Thanks very much.